I'm talking about companies like Uber, Airbnb, or even Google before they became household names. Imagine investing just a small amount back then and seeing it grow into a fortune. That's the allure of startup investing. It's a world filled with incredible potential, but also one that's not for the faint of heart. We'll explore why people are so drawn to it, how to spot a promising startup, and most importantly, how to protect yourself from the very real risks involved. This isn't about getting rich quick, it's about smart, strategic investing in the future. First, let's address the elephant in the room. Risk. Let's be crystal clear, most startups fail. The statistics can be pretty daunting. Some studies show that as many as 9 out of 10 startups don't make it. They run out of money. The market isn't ready for their product. The competition is too fierce, or the founding team falls apart. So, if you invest in a startup, there's a very high probability that you could lose your entire investment. Gone. Poof. This is why the number one rule of startup investing is to only invest what you can comfortably afford to lose. Never, ever use money you need for rent, emergencies, or your retirement savings. So, with such high risk, why does anyone bother? The answer is the potential for astronomical returns. This is what we call asymmetric upside. While your downside is capped at losing your initial investment, your upside is theoretically unlimited. If you invest in that one startup that becomes the next unicorn company valued at over $1 billion, the returns can be 10x, 100x, or even 1000x your initial stake. A single big win in your portfolio can more than make up for all the losses from the other 9 that failed. You're not just buying a stock. You're buying a piece of a dream, a vision for the future. You're funding innovation and helping to bring new ideas to life. Now, let's get to the exciting part. How do you find these hidden gems? How do you separate the promising ventures from the ones destined to fail? It's not an exact science, but there are key factors that successful angel investors and venture capitalists look for. I like to break it down into 3 core pillars: the team, the market, and the product. This is where the real work of due diligence begins. Let's start with the most critical element of all, the team. You can have the best idea in the world, but without the right people to execute it, it's worthless. I'd rather invest in an A-plus team with a B- idea than a B- team with an A-plus idea. So, what makes a great team? Look for founders with deep domain expertise. Do they understand their industry inside and out? Have they lived the problem they're trying to solve? Past success isn't a guarantee of future success, but it's a strong indicator of capability. Finally, assess their passion and resilience. Are they obsessed with solving this problem? Do they have the grit to push through the inevitable tough times? A startup journey is a roller coaster, and you need founders who won't give up when things get hard. Next up is the market. A fantastic team with a brilliant product will still fail if there's no one to sell it to. You need to evaluate the market size and potential for growth. The term investors use is TAM, or Total Addressable Market. How big is the overall pie? Then you look at SAM, the serviceable available market, the segment of the TAM that your startup can realistically target. And finally, SAM, the serviceable obtainable market, which is the portion of the SAM they can capture. Look for startups operating in large, growing markets. Is this a sector that's expanding? Are there major tailwinds, like new technology, changing consumer behavior, or new regulations that are creating opportunities? The third pillar is the product itself, or the solution. What problem is the startup solving, and is their solution compelling? A good product should solve a real, painful problem for a specific group of customers. Is it a nice-to-have or a must-have? The best products are painkillers, not vitamins. They solve an urgent need. Is it unique technology, a strong brand, network effects where the product gets more valuable as more people use it, or exclusive partnerships? Something that prevents competitors from easily copying them and stealing their market share. The product doesn't have to be perfect at the start, but it needs to show a clear path to becoming a category leader. Look for early signs of traction. So you've found a company with a great team, a huge market, and a killer product. What's next? Before you write a check, you need to understand the deal terms. This is where things can get a bit technical, but it's crucial. The most important number is the valuation. This is the price of the company you're investing in. You need to ask, is this valuation fair compared to similar companies at a similar stage? You'll also see different types of investment vehicles, like equity rounds, where you buy shares directly, or convertible notes and safe simple agreements for future equity, which are common in earlier stage deals. These convert your investment into equity at a later funding round, often with a valuation cap or a discount. It's essential to understand exactly what you're rebuying and how your ownership will be calculated in the future. In the past, this was a world reserved for well-connected, wealthy individuals. But thanks to changes in regulations and the rise of technology, it's become more accessible. There are now numerous online equity crowdfunding platforms like WeFunder, StartEngine, and Republic. These sites allow everyday investors to browse through startups and invest with as little as $100. Another way is to join an angel investor group or syndicate. These are groups of individuals who pool their money and expertise to invest in startups together. This can be a great way to learn from more experienced investors and get access to better deals. And of course, there's networking. Attend local tech meets, industry events, and demo days. You never know when you'll meet a founder with the next big idea. Once you've made an investment, your job isn't over. While you're not running the company, you are now a stakeholder. The best angel investors add value beyond just their capital. Can you offer your expertise? Can you make introductions to potential customers, partners, or future employees? Can you be a sounding board for the founders when they face challenges? Remember, you're on this journey with the founders. Their success is your success. Follow their progress, read their investor updates, and offer help where you can. To wrap things up, let's summarize the key takeaways. Startup investing offers the potential for massive returns, but it comes with a very high risk of losing your entire investment. Never invest more than you can afford to lose. To find promising startups, focus on the 3 pillars: a resilient and experienced team, a large and growing market, and a product that solves a real problem with a defensible moat. And finally, be more than just a source of cash. Be a valuable partner to the founders you back. But for those who are willing to take the risk and do the work, it can be an incredibly rewarding journey, both financially and personally. You get a front row seat to innovation and play a part in building the future. Thanks so much for watching. I hope this gave you a solid introduction to the world of startup investing. And I'd love to hear from you in the comments. Have you ever invested in a startup? What was your experience? Let's share and learn together. See you in the next video.